short video, I want to address the question around living on dividends and how should we really be looking at how markets are, especially as Harvard House investors. And so I'm going to use Standard Bank as a case in point. There's the Standard Bank chart. You can see that for most of 2019, Standard Bank traded between 160 and 200 Rand a share, depending when we were looking. And then as a result of both the downgrade and the coronavirus situation, we're now trading at 97 Rand a share, at one point as low as 90 Rand a share. And Standard Bank would be a share that is in many of our clients' portfolios. So I want to really take a look at this and maybe postulate at some of the position, because there's one thing that's pretty sure from a South African perspective, and I think it extends right around the globe. There are big sections of business who are customers of Standard Bank on the borrowing side. Either they've got car loans or home loans or possibly business loans, and they're not getting any income because they're the restaurateurs, they're the hotels, they're the shops that are closed during lockdown. And this is definitely going to have some sort of knock-on effect into the market from there. So if I move on to this next chart, this is an extract from an in-house system that allows us to track earnings and dividends paid by companies. So here you can see here the last price highlighted, 97 Rand 69 a share. And over here we look at the earnings per share. Now Standard Bank has a December year end and reports its earnings in two halves, and it pays dividends in two halves. Generally, the first half dividend for the period from January to June is paid in August, and then from July to December is paid in March. And here we can see the last year's period, December 19. So in the first half they earned 837 cents a share, and the second half 929 cents a share, and they paid a 454 cent dividend and a 540 final dividend at the second half of the year. So let's look at that a little bit closer, and we can see that they're broken down there. The dividend of 454 was improved on the prior year of 430, and they maintained the same end of year dividend for the share over that period. And even in spite of maybe earnings dropping a little bit in the second half, but the first half had a better period from that. So let's dig into this a little bit better or a little bit deeper, and we can see there's the details that I've put there. But let's assume that in the 2020 period for the first half, so trading from January to June of this year, because things are so dire, they decide they're going to withhold 50% of the dividend for the first half. So in August of 2020 they will only pay 2 Rand 27 instead of the 4 Rand 54 that they paid in the first period last year. Then in the second period, so for the trading period July to December, which is paid out in March 2021, let's assume that things have recovered a little bit by that period. Business is back and open, and people are paying and starting to recover. And so as a result, they pay 75% of the second dividend that they paid in 2019. So that would be an amount of 4 Rand and 5 cents. So in total over the year, they'll have paid 2 Rand 27 and 4 Rand and 5, which is 6 Rand 32. So for investors, that represents a 36% decline in the dividend versus a 41% decline in the share price. So this is the point that's very interesting, because those numbers look very close to each other. But if you're living on dividends, your income has declined by 36%. If you're living on capital growth, in other words, the share price has to appreciate in order for you to generate your income, then actually your income has declined by 100%. And any income you are generating is really out of capital. You're selling capital in order to do that. And we believe that as dire as this is for everybody, living on the dividend, which has declined, is far better than living on the capital value that has declined. So let's have a look at this going forward a little bit. So this is a track of the price-earnings ratio of Standard Bank going back to 2012. And you can see that really the price-earnings ratio has been as high as 16 in the 2014s, as low as about 8.5 and 9. But the average over this period is just under 12. And the upper and lower standard deviations are represented by the dotted lines. If we then have a look where we're trading at the moment, the share price is trading on a 5.5 price to earnings ratio. Now what the market is really saying there is that they don't believe that Standard Bank are going to maintain the dividends or the earnings. The market is indicating that possibly Standard Bank is going to drop its earnings by half. So let's look at those numbers a little bit closer. So we have a 5.5 price earnings ratio with a share price of 97.69. The average historic PE is 12 times earnings. And this means the market's saying that it's expecting earnings to drop to 97.69, the share price divided by 12, the PE, to roughly 8.14 per year from the current 17.67. And what buyers cannot work out is if this 8.14 is accurate, is it too pessimistic, or potentially is it even optimistic? Well, I think that would be probably not sure that we're on that page. So let's assume a 60% drop in the profits in the first half of the year compared to 2019. And that'll happen either because their bad debts will increase, there'll be no new lending, or there'll be non-payment of bonds, or people will fall behind, or whatever it is. So their expenses they'll have no new business, possibly still paying staff. So let's assume that the earnings are 60%. We lose 60% of them, so 60% of the 837 first half earnings is 502. So we're going to take that away from the first earnings. So the first half earnings will be 334.96 cents per share, down from the 837 in the first half of 2019. That's a pretty devastating result, but then shutdown is pretty devastating. Now let's assume that the economy doesn't go back to 100%. People are gun shy, they're nervous, there's businesses that go out, and so we only recover to 75% of the profits that were done in the second half of 2019, and that was the figure 929.60. So 75% of that is 697.2 cents per share, and that gives us a combined total of 103, basically 10.32 cents per share. It could be worse, but this is a pretty dire outlook. So coming back to our price to earnings ratio, which we're sitting at here. So what we've said is that at a 12 times PE on the historic earnings, the current PE is trading at 5.52. So if we look at that and we say, okay, if the market applies the same logic to the actual earnings, because bear in mind it was expecting 8.80 but now it's got 10.32, then we're likely to see the share price jump to 123.85, and that's up 27% from where it is now. The problem is we can't project the trajectory from here, but the bank is unlikely to go bankrupt. Really, the government cannot afford that. So really, ladies and gentlemen, the question is, does it make sense to reduce your portfolio to cash and only get 8% income from here? So on, let's say, one Standard Bank share sold to get 8% income, that would give you R7.82 per Standard Bank share and zero chance of any capital recovery. Or do you accept a reduced dividend of, say, R6.32? It's 25% less than the cash, but you probably get a significant capital recovery as things stabilize, and then potentially the dividends also come up quite nicely from there. And then 3, does it really make sense to invest in a way that your income is produced by capital growth? And so, as tough as things are, and even though dividends are likely to fall from here, we would still say that the Harvard House way of collecting dividends is still going to be more robust through this difficult time than trusting in capital growth, which has shown is just not going to be there for some time to come. Thanks for tuning in. I hope you found this helpful.